Hi there, good afternoon. You've tuned into ET now, and this is Market Fatafat with me, Cheryl D'Souza. Along with me, I have Vinny Motiwala. Very good afternoon to you, Vinny. And if you want to learn the art of patience and testing your patience, you have to see what Nifty is doing, because today it was only 2 points away from those.
It's an everyday story for us. 2 points away.
At least for the last 4 trading sessions, that's exactly what has been happening. Going towards that, actually, it's more of a tease. It's going towards that record high level and then just pulling back. And right now, we are sub those 18,850 mark when it comes to the benchmark indices. You have Nifty that's under pressure, Sensex under pressure, and today, shockingly, it's the broader markets also that are underperforming the benchmark indices. So take a look at what the small cap index is doing. That is down about 0.7% as we speak. It is it's Nifty Bank which is outperforming the broader markets as well as the benchmark indices. Nifty Bank is holding on to mild gains right now. But if you look at the advanced decline ratio, and the breadth of the market is very much in the favor of the declines right now. So if you look at the advanced decline, it is 1,409 shares declining as compared to 544 shares that are gaining. Talking about sectoral indices, then all of the sectoral indices are in the negative territory, barring the bank. Metal is nudging the flat line as of now. It's the PSU Bank Index that's the top sectoral loser. 1.4% downtick coming in for PSU Bank Index, followed by energy, realty, IT, pharma, all of them seeing cuts in today's trading session. But that's the way how the market setup is looking like, Vinny. We were towards that record high levels for the Nifty, and today, once again, we've not been able to hit that.
Absolutely not being able to hit that, but surely waiting for that level to reach anytime soon, hoping for that. But let's get started with all those stocks that are in focus, buzzing in trade, either on the back of news flows or on the back of technicals. And today on the technicals, we have Kunal Bothra with us, while from the research team, we have Lisa as well as Ashesha joining in with us. A very good afternoon to all three of y'all. Cheryl, good afternoon to you as well. And I'm going to be starting with the first stock, and that is Parity Phosphate. Now, this one is in focus because we have a brokerage note that has come in from Antique, where they've actually initiated a buy on this one. And what they is a target price which is of rupees 100, which is a 72% upside in terms of the return potential that they see coming in for the stock. Now, other than that, in terms of firing on all cylinders for growth is the word coming in from Antique on Parity Phosphate. There is a re-rating for this one on the cards is what they believe. They said that the company is actually poised to reap great benefits from its recent capacity expansion. The Goa plant acquisition is a boon for the company, and obviously multiple levers are there to augment the EBITDA per metric ton as well in terms of the positive up move over there that they are expecting. Growth visibility is mainly supported by a strong backward integration and volume, and has one of the strongest business models in the phosphatic fertilizer space, and that is why Antique is initiated coverage on this one and given a buy rating, and that is why you can see that the stock is buzzing in trade, up 6% as of now, 6.7% to be precise, at 62 rupees. Target price is of 100 rupees. It's a good run up that we could expect here.
All right, next up, let's talk about IDFC First Bank. Remember that this has been a top favorite for most of the technical analysts, Vinny. But today, in fact, there's a downgrade that's coming on IDFC First Bank, and this one is coming in from CLSA. They've downgraded the stock to an underperform rating from a buy rating, and you can see the stock not taking it too kindly, 5% downtick for IDFC First Bank. However, they've gone ahead and raised the target to 85 rupees from 80 rupees per share. What they're saying is the valuations do not fully reflect the unfinished journey on the ROE improvement. They're saying that IDFC First has been one of the best performers on a YTD basis among the Indian banks. It has outperformed Nifty Bank peers as well. But they're saying that while they like the bank's compelling growth story, they think that the valuation of 1.8 times 1 year forward price to book does not fully reflect the unfinished journey on the ROE improvement. They are, however, expecting 14% ROE by FY26 versus consensus estimate of about 11% core ROE reported in Q4 FY23. They're saying that the bank has done a decent job on liabilities post its merger with Capital First, but they believe that the asking rate on deposit growth will remain high for the bank. Any increase in the risk weights for unsecured retail loans could push up the capital requirement, and therefore they've gone ahead with that downgrade. And as you can see on your screen, like I mentioned, 5% downtick coming in for IDFC First Bank in today's trading session.
Let's move on and actually keep it with the banking sector then. And Kunal, HDFC Bank, obviously this has been on your list and makes it to your list once in a while on Market Fatafat. What is the view on this one? What is the run up? Today the stock is buzzing and up with a gain of 1%. So in terms of that up move, do you think that this up move is here to stay now, Kunal?
Yeah, it's been interesting for HDFC Bank because the stock was a big underperformer, and I think one of the few large cap names which had actually not participated in the last, I think 1 month or 2 months of this underperformance of large cap stocks. Now, HDFC Bank in the last 3 days has recovered very smartly from 1600 to now 1650 plus mark where it's trading currently. But this seems to be now a very strong recovery for HDFC Bank and could probably give an indication that maybe the worst could be behind the stock price movement. We could now also believe that the stock could now come back towards the previous highs of 1700, 725 in this move for itself. So hopefully with a time frame of 3 to 4 weeks, traders could consider buying as well as holding on to HDFC Bank for a potential target of 1725, which should take the stock comfortably past its life high levels as well as give a much more needed booster to the entire bank index.
That's the take coming in on HDFC Bank and what Kunal thinks of that particular counter. But Sriram Finance is the next stock that we are going to talk about. Lisa, and why has Sriram Finance made it to your list today? We know this particular counter has been a buzz since this start of the week as well. Today was the news flow.
Well, yes. Cheryl, Sriram Finance is not only a stock for today, but also since the last 1 week it has been trending. And a couple of reasons for that. Firstly, TPG sold its entire 2.65% stake in the company, and that was followed by Piramal Enterprise selling 8.34% stake. Prominent buyers included names such as Government of Singapore, BlackRock Global Fund, as well as Society General and BNP Paribas. On the back of this, Jefferies has double upgraded the stock actually to buy from hold, and the target price has been raised to 2,130 from 1,145 earlier. Well, the brokerage, they say that they have upgraded the stock following the stake sale by TPG as well as Piramal Enterprise, because that removes the key equity supply overhang. And also apart from that, FTSE Russell, the index aggregator, they have increased the investability weightage for Sriram Finance in the FTSE All World Index. So that is why the stock is in focus. It's down around 1%, but note that in the last 5 days it was up around 20%.
Okay, surely last 5 days up 20%. Today, I mean, some profit booking, I think it merits that as well. So keeping an eye out on Sriram Finance. Let's move on to the next one. And this other stock also that is in focus is Zee. This also has been a buzz this whole week. A lot of news flow that has come in here as well. And Ashesha, today we have some commentary coming in from Punit Goenka on Zee Sony merger. Yesterday there was some commentary coming in from Sony Pictures themselves as well. What is this commentary? What is indicated for Zee now?
Yes, you're right. This counter has been in focus for the last many trading sessions on the back of merger updates that has come in. Today, in an interview to Economic Times, Punit Goenka, the CEO and MD of Zee Entertainment, has clarified that Zee Sony merger will go through whether or not he is the CEO of the merged entity. He has also said that he holds about 4% shareholding in the company, and this merger benefits the balance 9% shareholders. He is hoping that the merger will be completed by September this year, and Zee Sony merger holds immense significance regardless of his position as the CEO. As far as the timeline is concerned, yes, he did say that it is expected to be completed by September this year. He says that the current contractual drop-off date is December 20th, 2023. He also says that if need be, they will probably reassess the situation and consider talks in order to ensure that the merger actually goes through. So strong commentary coming in from the management of Zee Entertainment with respect to merger. On account of this, the stock was buzzing in trade earlier in the day. Now, of course, it has slipped into the red.
All right, so that is Zee Entertainment that is in focus once again in today's trading session. Let me just mark the recovery that you're seeing on the bottom of your screen. Yes, you had Nifty Bank that was in the positive territory, but from the day's lowest point, about 0.6% uptick coming in for Nifty Bank. Even Nifty also seen a good recovery from the day's lowest point. Hopefully, we will try to make that dash to the record high once again. But Kunal, before we talk about markets further, let's talk about BEL and how is this counter looking to you on the charts? We know all the defense players have been a buzz. Also the fact that the Prime Minister is visiting United States, so we are expecting some more tie-ups with regards to defense to come about. But keeping that aside, on the charts, BEL looking attractive still?
Well, yes, looking attractive still. Consistent uptrend for BEL, higher highs, higher lows, as a consistent pattern for BEL over the last so many months. For the stock. In fact, I remember at a point when the stock was at 90-95 zone, where it was just closer to its 200-day moving average. From there on, the stock has charted a very decent, slow, steady, gradual uptrend. Now, I believe that at current levels of 120, 124, BL could be an attractive bet even from a trading perspective, and I would look out for targets of 130-32 for BEL. So I think closer it towards 120 mark, the better could be the initiation price for someone who's looking out for a short-term trade. 132 could be an immediate target for BEL.
Okay, keep an eye out on that target for BEL. Let's move on and talk about Dalmia Bharat. This one is in focus because we have Axis Capital that has actually cut the rating for this to a reduced rating and given a target price of 2,190 rupees per share, which is indicating a decline of around 3% for the stock in terms of the last price that was traded yesterday. But overall, yes, what we're seeing in terms of why are they reducing the rating also, because as of now, yes, the stock is trading with gains, but in terms of the annual report that had come out in terms of the updates from there, what they say is that for the capacity and expanding the capacity, the management highlighted 14 to 15% CAGR growth to around 110 to 130 metric tons by 2031. Also, however, they see that the net debt that is arising to around 7,740 crores in FY25 from currently 540 crores in FY23. So moreover, that increase that we could see coming in terms of the debt also, and that is the estimate in terms of earnings that could be adversely impacted due to the acquisition of JP Associates is a factor that Axis is keeping an eye out on, and that is why they've reduced the rating they've cut the rating to reduce from add, and obviously what they're keeping in terms of a target price is 2,190 rupees per share. As of now, the stock is down by 2% in trade, and that's the refresh chart. Given up all those morning gains that we saw, yes, that's the stock for Dalmia Bharat.
All right, so that is Dalmia Bharat for you. That is in focus in today's trading session. But let's shift focus to Cyient, and especially Cyient will be in focus given the fact that one of their arms, Cyient DLM, is all set to come out with this IPO, and we are joined by the of the company with Mr. Krishna Bodanapu, who is joining us on the show. A very good afternoon to you, sir. Thank you so much for joining us on ET now. And let's talk about your IPO and the IPO size. It actually cut to 592 crore rupees from 740 crore rupee, and the pre-IPO placement is cut to about 108 crore rupees from 140 crore rupees. If you could tell us what is exactly the reason for this sort of a cut coming in your IPO size?
So when we looked at the capital requirements that we had in the business and a few other parameters, we decided to reduce the size of the IPO from 740 to actually 700. It's cut from 740 to 700. As a result, there are some regulations that SEBI has in terms of how pre-IPO works. So the pre-IPO was just purely a function of the fact that we cut from 740 to 700. And the idea behind that was we just looked at our capital requirements, and we want to be overtly aggressive in how much money we raise, because we also have a responsibility to then deploy that money effectively.
Also, sir, just want to understand the usage of the funds that are expected to be raised, and how has been the investor interest in your roadshow so far?
So the usage of the funds is for a few things. One is we see tremendous growth in this business going forward. There are a number of reasons, both macro, which includes the fact that India is becoming a very attractive manufacturing destination, which includes the fact that the consumption of electronics is going up dramatically, the fact that Cyient has design capabilities which are very, very unique, and then Cyient DLM has manufacturing capabilities, etc. So there are a number of factors from a macro perspective. And of course, from a micro perspective, the quality of clients that we have, the quality of work that we've done, the long-term nature of contracts, our backlog, etc., that the growth potential has been tremendous. Therefore, we're looking at a couple of things. We're looking at funding the working capital. We have some debt, which we believe is better paid off right now because it gives us better capital structure and more efficient capital structure. And we've left a little bit of money aside for other corporate purposes, including a small acquisition potentially, just to enhance some of the capabilities that we have. So this is the use of funds. I'm very grateful to our investors or the potential investors that the interest has been really fabulous. We've had a number of conversations, and we're seeing the interest at a very, very high level, and we're very grateful for the confidence that they're showing in us.
Right. In your RHP, you have mentioned that Indian EMS industry is going to grow at about 32% CAGR. While last couple of years, if you have actually reported early teen growth at around 13 to 15%. So going ahead, are you going to be expecting an exponential growth in that particular domain, or do you see that it will remain at around 13 to 14%?
No, we do expect fairly significant acceleration in growth, and this is based on the order book that we have and the pipeline that we have. The last few years, there were some specific issues. We were also trying to make sure that the quality of business improves. So we have given up a significant amount of business because of the quality, be it the margins, the predictability, or even the kind of work that we were doing. So what we've tried to do over the last few years is make sure that the business is a solid, healthy business with a solid pipeline and good economics, and I think that's what we've achieved. So we will get to at least the average of the industry going forward, if not higher than that. So we're quite confident of that.
Also, sir, just in terms of your client metrics, when I'm going through that from FY22 to FY23, there has actually been a drop in terms of the number of clients from 50 to 37, and thereabouts. The new addition is also limited to just one. What could we get in terms of an understanding on this? What was the reason behind this decline? If you could just give us an understanding.
So some of the clients are really a point in time because of the cyclical nature of the business. But I'll say we're very, very confident in terms of the clients that we have towards. So again, I will come back to the point I made in terms of the quality of clients rather than quantity of clients. I think in this business, it's very important that we have the right quality of clients. So we've really focused on making sure that that quality of clients is there, because growth with those clients over the next 5 years will be much easier, will be much more manageable, will have much better economics. So it's a very conscious decision that we're taking in terms of making sure that we have the right client base in terms of quality, not necessarily in terms of quantity.
Right. EMS is understandably a low margin business, but given your niche, is there any case that you can improve your EBITDA margins to at least double digits? And the reason why I'm asking this, sir, is the fact that your net level profit margins seem paltry at just 3 to 5%.
Our EBITDA margins will increase. They will be in the double-digit range. I think our aspiration is that EBIT also should be about 10%, which is as high as it will get in the EMS industry. So again, like I said, we've done a lot of work on the economics of the business and quality of clients, and that's actually playing out. I mean, we will see a continued improvement in margins. Foremost starting from the gross margin, which is already visible, but with growth, because we've also made a lot of investments in sales, in the leadership team, in systems and processes. So as growth comes, the absorption is going to kick in a fairly significant manner. So getting to 10% EBIT is in the roadmap, and we're quite confident that we will get there relatively soon. So that's as high as this business will get, and that's also a function of the fact that we're doing high quality work in some niche industries and not necessarily going after very scaled industries like, say, a consumer or a communications.
All right, so we'll leave it there. Thank you so much for joining us on the show, and all the best for your IPO, and that is the management of Cyan DLM. It was the chairman of Cyan DLM who spoke to us. And remember, the IPO price range is set at around 250 to 265 rupees per share. But let's move on and let's talk about Mahindra and Mahindra Financial Services. And while particular counter in focus in today's trading session. You can see the stock is under pressure, down about 3.7%, steepest intraday decline coming in for the counter since March 24th. You had dollar analysis. Basically, they've highlighted a weak asset quality performance as well as operational efficiency lagging peers. They're also saying lack of portfolio diversification and low quality housing books as a negative for Mahindra Financial. They're saying that the weakness in rural and agricultural economy is driving lower than anticipated AUM growth, while the asset quality blips are posing risk to the rating as well as the target price. So they've initiated a coverage on Mahindra Financial with a reduced rating, and the target that they've set is just 315 rupees per share. If you can see, the stock is almost around those levels.
Okay, moving on and putting the spotlight on Jubilant FoodWorks, and this is on the technicals. Kunal, this one has not done pretty much anything in the last 1 year. Now, what are the charts indicating?
Today there was a brief attempt for the stock to break past the 200 DMA. I think the stock had crossed about the 500 mark. 505, 510 was the high in terms of futures for the stock, and I think that could probably be an indication that even the longer term trend for Jubilant Food is getting into more of a reversal mode. Now the stock has retraced from the day's high, but I believe that with consistent attempt possibly towards the 500 mark and a potential breakout which could sustain above the 500 levels, this could be an interesting bet from the entire QSR space. We've been discussing many of the stocks from this particular sector, but I think Jubilant Food had been a huge underperformer. But with a breakout potentially above the 500 mark, and if it closes above those levels, I believe that this could also be one of the few stocks which can make a strong comeback. So we'll be bullish on Jubilant Food if it sustains above the 500 mark on closing basis.
So that's the take coming in on Jubilant Food. Lisa, coming to you, HDFC AMC is the counter that you're going to talk about, and why is this one in the spotlight in today's trading session?
Yes, absolutely. Just 2 days ago, Aberdeen Investment, they had sold their entire stake of around 10.2% in HDFC AMC, and this stock had rallied that time. And the buyer name is out. One of the prominent buyer is SBI Mutual Fund, who bought the stake from Aberdeen Investments. Now, on the back of these block deals, the free float has increased, and FTSE has announced a free float adjustment in HDFC AMC. The inflows, owing to the increase in float, that will happen on 23rd June, that is tomorrow. And as per Nuvama, the expected inflows for HDFC AMC will be around $16 million. Well, analyst is saying that this stock is likely to be an outperformer as the recent exits of the large investor that has removed the supply overhang of the share. And also analysts are quoting that with the continued strong SIP inflows, the strong distribution network, the rising market share as well as operational efficiency, HDFC AMC can be a good bargain to buy at current level. So that's on HDFC AMC today.
Ashesha, let's talk about Allcargo Logistics. This one has come out with their volume numbers. What are the numbers looking like? What are the indications coming in, at least from the street, and what is the stock price doing?
Well, yes, the company released operational updates for the month of May yesterday post-market hours, and LCL volumes, although on a month-on-month basis we have seen an increase of about 3%, on a year-on-year basis it is a decline of about 5%. Management says that in line with their expectations, YOY trend continues to remain subdued, reflecting the tough macroeconomic environment for global trade. They also say that a pickup in global trade is expected by major shipping lines as we near the second half of FY24. At the regional level, they have highlighted that America recorded the highest LCL imports since August 2022. In Europe, the situation remained mixed. As far as container utilization is concerned, that too was on the lower side. In fact, it has been declining for the last 2 quarters due to post-COVID normalization of trade activity and related inventory restocking. So that's as far as operational updates are concerned. LCL volumes have seen a dip, and the management is cognizant of the fact that the volumes have been declining on a year-on-year basis.
Alright, so that's all about Allcargo and why that one is in focus in today's trading session. But on that note, we'll actually slip into a break on this edition of Market Fatafat. When we come back, a lot of stocks to discuss, and also we'll take a check on the markets as well. So be back soon.